Nikki says, how can we use our super to pay our mortgage? We are nearly at our preservation age, but want to work beyond that. I think the rest of the question was. We had a bit of a problem with some of the questions being cut off. So how can we use our super to pay down our mortgage? What you do is you move from your accumulation phase to pension phase. Sorry to be a bit of a broken record, but check out the retirement planning webinar, cornerstonewealth.com.au/retire 2014. How the transition to retirement strategy works and explains it in a fair bit of detail. But the thing that you need to factor in this scenario is generally when people are under 60 years of age, they've reached the preservation age. So Nikki's about to reach a preservation age. And let's say, for example, that's 56 years of age. So let's say Nikki's 56. I don't know, Nikki is 56, but if she's soon to reach a preservation age, it's probably around that. So if she's 56 years of age, then she might have, let's say, $200,000 in her super fund in her accumulation phase. And that's in the accumulation phase of super. So what Nikki can do here is that she can roll over, can leave a minimum balance in the account and roll over the rest of the money. So let's say $195,000 to the pension account. And you just leave a small balance in. So this balance then goes down to like $5,000 rather than $200,000. Nikki needs to draw, when you're 56, you need to draw between 4% of the balance and 10% of the balance. When people are between 56 and 59, as in they're not yet 60, the drawings from the fund, so the money that Nikki then draws out of here, say for example she drew 10% or $19,500 in pension payments. This $19,500 adds to Nikki's taxable income. So if Nikki's earning $70,000, this $19,500 of pension payments from her Christian pension account is added to her taxable income. She's going to pay 34. I've made this a bit trickier than I needed to. Let's say her income is $60,000. If her income is $60,000, then her taxable income ends up being $19,500. Sorry, $79,500. So this $19,500 of pension payments is then added to her taxable income. Now, she pays tax on that additional money, 34.5%, because she earns between $37,000 and $80,000. She gets a rebate on this money, depending on the components. It could be not all taxable, but as a general rule, most of this money would be what we call taxable components, and she get a 15% rebate on it. So 15% rebate on that money, on that $19,500, which means the effective tax rate of this $19,000 that she draws is the difference between 15 and 34.5. So she pays effectively 19.5% tax on those drawings out of the fund. So what we generally recommend is when somebody is of preservation age, but not yet 60, so they're 56 or 55 to 59 years of age, we generally say rather than withdrawing a pension amount of the maximum 10%, which is good to draw because you're paying down the mortgage, we often suggest drawing the minimum amount. So you're getting the benefit of being in the pension phase, as in you're paying no tax on the earnings within the fund, but you're trying to minimise your income tax as well. So rather than drawing the maximum, generally at that stage we say draw the 4% minimum amount. Oh, that's terrible. A 4% minimum, but if you can read that, you're doing well. But yeah, drawing 4% minimum, so drawing the minimum amount from the pension account rather than the maximum 10%. You might want to draw down the 10% to pay off the mortgage, but because you're still potentially paying a little bit of tax on the drawings under 60 years of age, then I'll be drawing the minimum. Once you hit 60 years of age, at that point in time, it's well worthwhile potentially considering the maximum. So at that point in time, you might draw the maximum of 19,500 or the maximum 10%. Hopefully that explains that question for you, Nikki.